Are you or your clients looking for a regular income solution with compelling returns to diversify your portfolio? If so, Neighborhood Holdings may be a great option for you. Listeners of this podcast will appreciate that public markets can be turbulent and finding a good private credit fund can be tough. But Neighborhood's track record, transparency, and investor alignment sets it apart from the pack. With nearly 10 years of consistent performance and a target net yield of 8 to 10%, Neighborhood has a track record of providing monthly income to investors without the volatility of public markets. How do they do this? Where banks invest in mortgages up to 95% loan to value, they also make borrowers jump through a lot of hoops. Many borrowers in transition aren't able to meet those hoops. Neighborhood has partnered with banks and brokers to provide quality borrowers with temporary financing secured by first mortgages at an average loan to value of less than 60%. Where other mortgage funds might take more risk by lending against construction, bare land, or jumbo loans, Neighborhood is focused on your average residential borrower who owns the average house in the neighborhood. Plus, their variable rate with a floor mortgage pricing benefits investors when interest rates go up and mitigates downside risk. Check out the link in the description or visit neighborhoodholdings.com to view the offering memorandum or speak to your financial advisor for more information. That's neighborhoodholdings.com/Loonie Hour. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back or have the shortest memories when it comes to investment. We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to Loonie Hour, episode 175. As always, joined by the three Mugos, Boomer, Keith Dicker, Rich Diaz. What's going on?
Well, we have like everyone else on the eastern part of the country today, we have the snowstorm blowing in this afternoon. I think the GTA Pearson got 30 centimeters this morning. Rich, you're getting some this afternoon, I guess?
45 centimeters.
Yeah.
We have more snow because taxes are higher in Quebec.
Isn't it crazy? We're getting snow during winter in Canada. That's unbelievable.
You shovel your own driveway, Boomer?
Of course not.
No chance he does, eh?
No chance. Yeah, right.
I enjoy a good.
He sends Mrs. Ice Cap out.
Yeah.
Lock the door.
If it takes me an hour to do it, it would take her 20 minutes. She's pretty good with all that stuff. How about you, Rich? What's going on there besides your you have a lot of enthusiasm today. Look at you. Holy
Do
smokes.
I? No, I'm dressed up because I did the Ice Cap Canadian market wrap. What else? Everybody's freaking out about the snow. I can't wait to get out there. I'm gonna go
You play outdoor puck or what?
No, I gave up hockey a long time ago.
Oh man,
gonna
no wonder
build
that's
a
why you're
little
not getting any
snowman?
dates.
Yeah. I'm gonna build a snow woman for myself. How about that? How about that, Steve?
We prefer a snow person.
Yeah, that's right.
Yeah, how would it even work? Like, what would you
Delicately
say to your snow person?
Well, I would promise them the world. I'd tell them I love them.
You can't tell them they look hot. Huh?
Oh
Huh?
my god. Oh, Steve, save
Let's
us,
go,
please.
Steve.
All
With
right.
that one, let's get it going.
There's your Boomer joke for the episode. Yeah, we had Sam Cooper on obviously last week, and we'll kind of get into that. We have some updates on the fentanyl discussions, the Fentanyl Czar, lots happening in the Vancouver, Toronto, Calgary, et cetera, real estate markets. We'll get into Stats Can. We had some job numbers from Canada last week, which we think is really important to dissect in this week's episode. We had the Fed's CPI data, which I think is important. And so there's a lot, there's lots going on. So we'll kind of get through it. But on the real estate front, we had the January data that came out. So kind of one of the core themes that we've been talking about on the show here is the investor bid, which has really evaporated in these really frothy markets like Vancouver and Toronto, where, like, let's be honest, the math doesn't work. It hasn't worked for a long time, but people were speculating on ever higher prices, ever higher rents. And that's obviously all unwinding now. So if you look at the number of new listings for condos in Toronto, it was an all-time high in the month of January. So there was just over 4,500 condo listings in January. which, yeah, over the last almost 2 decades, we haven't seen a number like that. Same thing in Vancouver. It was a 20+ year high in the month of January. So basically what's happening here is you have a record number of new listings hitting the condo market inventory. And the reason, of course, in my opinion, is what we're seeing is a lot of these investors that tried to sell last year, they didn't like the numbers they were getting, didn't like the price. So, you take it off the market in the sort of November, December, and then you kind of come back on, you try your luck again, you relist the property in the new year. So I think a lot of that, I think we also have a lot of conversations today, at least in my business, where people are saying, oh, well, Steve, you quoted me a number last year. Um, didn't like that number, so decided to rent it out. The tenant's now, moving out. What's the new number? And I say, well, the new number is the same as the last number I gave you 12 months ago. And so people are now facing the decision. Well, do I put another tenant in for another year and hope that maybe the price is better 12 months from now? Or are we just going to continue to sort of grind sideways, for the next several years, right? And so I think we're seeing more and more of these investors basically saying, okay, well, I think I'm ready to get out. And this is obviously, pushing up the supply, and I think now is putting some pressure on pricing once again. So we'll see. But
Steve, from the, that's from the seller's perspective, of course. From a buyer's perspective, are prices now coming down in your market so that it's actually more affordable and more attractive for people trying to get in for the first time? But people want to move away from renting.
it depends on the product type. I mean, I think the stuff that like typically investors would have absorbed, maybe smaller 1-bedroom condos, 2-bed condos in the downtown cores, like things that like investors would be the majority buyer, like that stuff is seeing, I think, some price pressures. I think the end user stuff where a young family might buy, let's say, a 3-bedroom townhouse or an entry-level detached house, those prices are pretty firm. So it's really it's honestly like it's a tale of like two markets right now. It's like, what do you have? Where is it located? And this is the same conversations I'm having with realtors in the GTA. It's just like that investor market is really impaired. And I'll say this, like I think the GTA from a price perspective, from a market perspective, is like way worse. Like the GTA is the epicenter of the Canadian real estate correction. And which I think is important when you get into, okay, well, if that's what's happening there, you've got 30-year lows in pre-construction sales in the GTA. Now you've got tariffs, which I think tariffs will impact Ontario the most of anyone. And so you're like, man, that economy is going to be really under pressure over the next 12 to 24 months.
Steve, can I ask you a question? So you say in Toronto, you said, what was it, 4,500 condos?
Yeah, 4,500 new listings.
New listings, excuse me. What percentage of those is like the dog crate condos, you reckon? Like, I know it's tough.
Yeah, I don't know. So, when you say 4,500 new listings, that's like the resale market. Then you have like the shadow market, which is like your pre-construction inventory. That typically doesn't go on MLS. That's usually just on developer books at presentation centers. So that inventory doesn't count towards it. It's funny. There was an interesting article in the Globe and Mail this week that people were sharing on Twitter there. And, we talked about it on the show before, and it was kind of like, I think when I put it out there, like if you weren't in the industry, everyone's like, wait, what? That's happening? And it's funny that it's been now shared in the Globe and Mail probably a year later, where they put out the story on this Toronto pre-construction buyer. So he purchased a condo during the pandemic at the top of the market for $2.2 million pre-construction.
Mm-hmm.
It was recently appraised because now it's closing, right? He's going to get a mortgage at a lender. And the appraiser came back at 1.6 million. So he bought it for 2.2, but it appraised at 1.6. So he's got basically a $600,000 gap. But the developer and I guess the sales team there was like, well, hold on a minute. If you put it through RBC's done blanket appraisal on this project. And so we'll appraise the entire amount. We'll just assume that it's still worth 2.2. Don't worry about that independent appraisal that you got from a different sort of lending source. RBC's done the blanket appraisal on this project, and we'll still lend you 80% of 2.2. So effectively, this becomes like 100% LTV mortgage.
Hooray!
On RBC's books, right?
So very quickly, why would RBC do that? Like, what's the catch? What am I missing?
The catch is basically that RBC is involved typically on the financing side of the construction. So, right. So when the Mr. Big developer goes and builds a high-rise tower, they're usually slicing out tranches to several lenders. So it's usually like RBC doesn't typically finance the entire construction, but they'll go out and say, well, listen, like we'll take a big chunk, and then maybe BMO will come in for the other bit.
So they're doubling down, basically, right?
Yeah. So basically, the question is this: is like, okay, so if you're RBC and you lent like I don't know, $100 million construction financing, for example, on a tower, and all of a sudden, all your pre-sale buyers, the values don't hold up, so all the pre-construction guys that bought in basically can't close because like they have to come up with the excess cash to cover the shortfall. It's like, well, do we want all these buyers to basically be in default and walk away, which puts us even in an even worse position, or we'd rather finance these things effectively at 100% LTV and kick the can, 3 years, 5 years, 10 years down the road, and hope that the market recovers and we get paid whole eventually 10 years down the road.
So I've noticed so far in the conversation, you used the word hope 3 times now. Twice in Vancouver and once in the GTA. Go ahead, Rich.
I just wanted to say I vote for kick the can. Kick the can.
But like, what do you do, right? I mean, this is effectively what they're doing. So these blanket appraisals are becoming almost like a little loophole that, I mean, I've always said this from day one. Like when you're in the industry, you kind of start to figure out that the big 5 Canadian banks effectively run the country.
No, how dare you?
Whether that be through these blanket appraisals or whether it be through.
Only there was one gentleman that set above all of them, and he did it in Canada and Europe. He can come back.
Think about think about like the when people were on those variable rate mortgages where the amortizations blew out to like 50 years, 80 years, 90-year amortizations. Like that's effectively a mortgage in default, but like the banks are just like, nah, it's okay.
Yeah.
Just
so
defer
Steve,
the interest.
With RBC doing this, I assume, it's the RBC, TD, BMO, and Scotiabank. They're also doing it on
yes, but on certain
properties?
it depends on the project, right? So like, well, for example, like, oh, well, on this project down the street, TD's done blanket appraisals. So it's like, well, again, if you look at it, in my opinion, the only reason why the banks, I mean, it might not admit to this, but the only reason why they would offer 100% LTV is clearly they have to be involved on the construction financing side.
Yeah. They'll do everything they can to just not take losses. I mean,
yeah,
to avoid writing it off, right? I mean,
yeah. So I think when you come back full circle to this conversation, you have 5 Canadian banks. They basically run the country. They basically make up the rules, and they insulate people and themselves from incurring losses. This is why you don't have like natural corrections, right? Like a natural correction is like this basically this project has all these buyers that can't close, and
default, they get wiped out, and the price would drop by 30%.
The developer essentially defaults, and these get.
It's a full embrace. Everyone's embracing socialism. That's what it is.
What is it? Socializing the losses or whatever.
This project should basically, right? Like if you have 30% of the building that can't close, that developer is screwed. And so what happens is that loan gets defaulted on, effectively goes into bankruptcy, and those units get liquidated at, a 30% discount. And that's the market. But
and then the next building goes down. And
and then, I'll say this, like when people say, oh, this is, this blanket appraisal, these huge shortfalls of valuation from what you bought at pre-sale to closing today. It's largely a GTA story.
Okay.
It's
Well,
happening
that's
a
what,
little. It's happening a little bit in Vancouver. We've got a little bit of it, but it's like the GTA is like a totally different, like on another playing field.
well, that's what I wanted to say, because you know that amazing. There's a guy on Twitter. I think his name's Hanif, and he runs Wawa, which has such good data. I'm
Say
really
that again. Which guy?
His name is Hanif, Hanif. You can follow him on Twitter, and I don't know his last
Yeah, he
name.
started that site wawa.ca.
Yeah,
It's got a lot
brilliant.
of good
Oh yeah,
financial info.
absolutely.
He's
Yeah, yeah.
he's brilliant. I'm very jealous. Anyways, because I was looking at like Montreal housing markets, because I think one of our very loyal listeners was giving us shit that we don't talk about Montreal enough. Because I'm seeing the condos are up 8% month on 8% year on year, and then like all family detached and Calgary too. So is it really just this is it really like Calgary, Vancouver and Toronto are going down and everyone else is going up? Is it like that clear and obvious?
Toronto's definitely going down. Vancouver went down, kind of flat, but whatever.
Okay.
Just assume it's going down. Calgary now has peaked. I can tell you that Calgary's peaked. That was like the one market that kind of stood out, where it was like everything was kind of coming down, that was going up. I think Montreal, that's probably like, okay, sure, maybe on a year-over-year base effect, the prices are up. But if you kind of look at like where Montreal valuations peaked 2 years ago before the rate hiking cycle to where they are today, they're modestly lower. But yeah, the severe corrections are like outskirts of the GTA, where you're seeing 30% price corrections.
Crazy.
And then these high-rise towers that, were pre-sold at whatever, 1,600 a foot, and the resale market's at like 1,200 a foot. So yeah, I don't know. That's the core theme this year. I still believe is the trend is going to continue, which is like, yeah, mortgage rates are down, but people paid too much for these units near the peak. None of them are cash flow positive. And if you're an investor, and I have these conversations quite frequently with people that call up and say, what do I do? You're negative cash flow $1,000 a month. So you're just bleeding, right? You're bleeding 12 grand a year. For how long? Like the conversation was like, well, like I'd like to get out, but I don't want, like, if I get out today, I'm gonna lose $100,000 net of fees and taxes and everything. So I'd rather bleed out 1,000 a month as opposed to take my 100K hit today. So the question is really like, well, how long do you want to do that for? Because like I don't know where the prices will be in a year from now, 2 years from now, 3 years. I mean, we went through a lost decade in the 90s, and I mean, maybe this is our lost decade where like your valuation ain't coming back for 10 years. So if you're bleeding out 12 grand a year for the next 10 years, I guess you hope now you hope that the rents go up, maybe to offset.
Two more hopes is 5.
So on the rent side, we had more data from rentals.ca. I mean, rents are declining in many major metros, Calgary included, because they are very much more of a free market where they actually can build. They can build enough supply to oversupply the market and actually bring the market down. So we're seeing rents are down in Vancouver 10%, GTA 10%, vacancies are higher. And I think this goes into our next conversation, which is population. Like, how often is it that you get declining rents, outside of a recession? Like,
well, we're in a recession.
Yeah, that's the thing, and nobody wants to admit it. And the economic numbers look okay, the jobs data looks okay, but like,
it looks sensational.
It's amazing. So many jobs.
double digit rent declines in like many major metros across the country, like that. You don't see that in a booming economy.
So so I'm looking at rentals.ca, and of the top 15 cities, there's only 3 that have positive. So it's Halifax 2.2, Waterloo 1.2, Barrie 4.4, Guelph 3.3, and everyone else is negative year-on-year growth.
And I wonder if you get places like Barrie where it's like there's just so little inventory that like it skews the data.
But like Burnaby, BC, negative 10%, 1%.
Oh, yeah.
That's crazy.
I mean, I'm 25 minutes from Burnaby. I can tell you, like they built an egregious amount of like high-rise
Wild.
towers there, and it's just like there's so much
Well,
supply
it's
right
the
now.
same here. I mean, if you come down to our part of the world, like there's so many buildings and the cranes are still moving around. There's a big rush to completion, and they're not filled yet, of course. So it'll be interesting when they come up. But with the whole, so with the GTA, then, I mean, they're having challenges, but the way for everyone to get out of this is if the economy doesn't slow down, it stabilizes, and then it can literally grow its way out of the problem. And, maybe it takes a long time, or maybe it can be a quick rebound, but that's the solution to the challenge. If they do have a recession there, which, I think Rich has been showing some great data on that, then the challenge will get worse there. It will continue to deteriorate. I guess that's the best word to use.
Trend lower.
Trend lower. Thank you, Rich. So if you're bullish on the GTA economy, which is Ontario and everything, then maybe we've reached the bottom for that challenge. I don't think we have. I
Just
think
call the
you will.
bottom.
No, I said I don't think we have. I don't think that's the
Well,
bottom.
okay, so just in the interest of transparency and clarity, I think it's important to know there actually are a bunch of indicators that have rebounded. Now, I think this is sort of I'm not sure I'm totally convinced, but we got to be honest about it, and I'll share the chart with Steve, which is like the business barometer. The CFIB business barometer has rebounded a little bit. The RBC market with an I, a manufacturing PMI, is above 51. So that's okay. And then the BOC's business survey future sales has actually rebounded. I mean, I don't understand how to square that, to be honest.
Well, yeah, let's throw you for a loop now. So square the Canadian jobs data for us, because that was a huge monster bounce. 2 months in a row now, Keith. Monster rebound in jobs.
What was the headline number? What was the headline number?
Rich?
Oh, I think it was like
I don't know what it
over
was.
100. It was 100,000, wasn't it?
Yeah, it was. No, I have it here. Sorry, I had it.
92.
Employment change was 76,000, which was it was 3 times bigger than expected.
So for the U.S., for example, that would be like an $800,000 print, for the U.S. economy.
Yeah,
which
it's roughly 10 times the size. Which is crazy, even like that was only.
So walk us through the number then, Rich. Like, what? I mean, you're sort of grinning a little bit, that maybe you're not buying that number. You're not picking up what Steve's putting down. Put it that way.
I'm not picking up what Steve's putting down, and I think that there's 2 ways to look at it. One is always to find a confirming data point, which I'm furiously scrolling down to find. And what we're seeing in the CEF, what is it called? The Survey of Employment and Payroll and Hours or whatever. I always screw up the names of these acronyms. But we're seeing that actually start to come off. And so the major difference between those 2 surveys, the CEF and the Labor Force survey, is basically self-employment. And the problem with that is there's all kinds of funny business that happens in that sort of other element. The other thing that's really important to note is that if you exclude public administration, health, and education, which are obviously sectors that are dominated by the government, we basically have had no growth. That's I stole that from Ben Rabideau, friend of the show. Excuse me, Bob Sacamano. And so I think that's really, really important point too. So I think and then there's another piece, right, Steve, where it's I think one of the indicators that he highlighted I thought was really, really smart was something to do with telecoms, right?
Yeah, well, yeah, I'll walk you through that. So we did, we had the jobs numbers that came out, and we're all kind of like scratching our head. This, doesn't quite go with the way that we see the world evolving, and perhaps the narrative that's been developing in Canada and the weakness. And so we decided to call a friend. We used the lifeline, and we called Bob Sacamano. And, because he's kind of been all over this, and this is what he does for a living. And basically what's happening here is, and Ben, forgive me if I get this completely wrong, but effectively StatsCan is having issues quantifying the outflows on our immigration. So basically what's happening is there's a huge divergence between these two labor force surveys. You have the SEPH and then you have the labor force survey. Rich, the annual growth in the SEPH is moving lower and lower.
Yeah, that's right.
And the labor force survey, which is the one you read on the news with the big headline, wow, massive beat, is that one's moving in the other direction. So you have two surveys going in two different directions. And you say, well, something has to give here.
Well, one of them is wrong.
One of them is wrong.
Which one is RBC hoping is right?
So for example, Canadian businesses shed 56,000 positions in November in one survey, and then in the labor force survey, it reported a 42,000 increase.
It's not an immaterial difference, by the way. It's not just a bunch of nerds navel gazing and trying to outduel themselves with like fine data points. One is literally suggesting that the employment number is growing at a pace we haven't seen in months, and in almost a year, I would say, actually. At 76,000, that would have been the highest number in almost, sorry, I lied, 8 months or so. And the other one had the biggest drop in 11 months, right? So
Rich,
these are wildly diverging numbers.
You'll know better than I don't know how they put these sort of data sets together, but effectively the labor force survey is overestimating population growth. And by doing so, you're overestimating employment growth by default. So obviously it goes into some sort of model. There's all the quants in the back room that are sweating it out. And effectively, you remember, right, on the temporary foreign worker side, we don't count outflows. We don't there's no agency that measures people leaving the country. So we're basically just effectively guessing.
Yeah, well, let me just give you some let's take one half step back. So like the labor force survey is a survey. And now people say, oh, how could you use a survey to figure out what's going on? Virtually every single piece of data that we look at and assess and use and rely on is a survey. So you wouldn't actually count 42 million people, call them up and say, are you working or not? You basically call about 5 or 10 or 15,000, I can't remember the number, and then you extrapolate that onto your bigger population with sophisticated models, and then you obviously go back and revise these numbers. Now, the revisions can be large. There was actually just on January 25th, they published a revision table where they went back and told us what they did and why and how, and you can dig it up yourself. The other one, the CEF, which I can never remember what the freaking acronym stands for, Survey of Employment Payrolls and Hours, is different. That's based on literally your payroll slips. And so it's always like 2 or 3 months behind, right? So the labor force survey is up to January 2025, and the survey of employment payrolls and hours is up to November 2024, right? So it's 3 or so, whatever months behind, but it's much more, let's say, quote unquote, accurate because it's based on just those, like literally the slips on top of some surveys. Sorry. I know that was very boring for some people, but for me, it's important to.
And just to add to that, I'm going to give Ben a plug here. So if you are a institutional level investor, he has North Cove Advisors, his grid research service there. If you're in the real estate space, it's called Edge Analytics. It's a more sort of simplified version. So I highly encourage you to check that out. But basically, he's tracking the number of workers that are unemployed for 27 weeks or more is I mean, hockey stick upwards. Number of workers unemployed for 52 weeks or more. So you're like, well, why is it taking people longer and longer to find a job? Permanent layoffs surged to the highest level seen since March of 2021. So I think when you kind of unpack the underlying headline, the jobs data, I don't think is what the random number generator is telling you it is.
Yeah.
So what's exciting about this, from the insensitive side, is that it's likely we're going to see some pretty dramatic changes to the headline number on the employment report coming up. Is it next month or the month after? We don't know, but these numbers should reconcile at some point. And the data that we're getting, from Ben's side, it is suggesting that the headline number is wrong. So once we see the headline number start declining, it's coming down, The market will react to that. So the Bank of Canada will react, of course, and they're probably going to have the opposite reaction to what the Fed reacted, with their data point this week. Remember, everything's connected here. It's not just three guys talking about some hopeful things happening in the GTA, and like we're at a serious turning point right now for our economy.
Yeah, I just wanted to add to that. So this just kind of goes to Ben's point about, is the labor force survey overestimating population growth? Like basically they're not quantifying all the people that are leaving. I mean, we just talked about, hey, listen, like rents are down double digits. I mean, like to me that's a pretty clear signal that, hey, I mean, maybe people are leaving and you're having more vacancies, and so rents are declining to offset that. You can also see that in Canada's publicly traded telecoms. So Bell Canada last week said there was 56,000 net new postpaid wireless customers in Q4. That was down 56% year over year. And then we just heard from TELUS today, net additions down 44% year over year in Q4. So I don't know. I mean, there's telecom user growth is plunging, rents are plunging, vacancies are
Rising.
up.
And more people are working. I don't know.
Yeah, exactly.
So that doesn't pass the smell test. So we'll see. I mean, this is interesting, right? I mean, I always found it most interesting, that like you have, agencies like the Bank of Canada that are basically setting the price of money on some of this data. And some of this data is not always necessarily that reliable, but.
Well, wait. Hold on a second. They're not totally.
Oh, yeah, here we go.
How come I'm always in the position to defend the Bank of Canada? Anyways, they obviously know. They obviously know that they don't just look at one data point. I'm sure they have the same charts that.
And in the same vein, though, I mean, all the the bank economists who are following this as well. I mean, their numbers are a lot lower to what they were expecting as well. So again, it is likely that the official numbers for employment growth in Canada, it's going to trend down. And so in the big picture, perspective, has the trend in Canada, the economic growth is grinding slower, or on a per capita basis, it's in a recession already. We're going to the uncomfortable moment. Has that trend changed, Steve?
No,
I don't think it has. No.
Yeah.
And there's another way of looking at this, by the way, just because, often if the numbers were, let's say the employment numbers were as good, or sorry, let's just take it for granted the labor force survey was right, and we had, almost 150,000 new jobs over the last 2 months, we would have some response in my view, in the GDP forecast. And so yet the GDP forecast, the consensus estimate for GDP forecasts are stuck basically. They haven't moved at all over that time. And I think that's really important. So 1.6 for this year and next year. So take that for what you will.
That's the BOC's forecast?
No, this is the consensus economist forecast. So it's like all of the economists submit their forecasts, and they sort of take a median number. And that's stuck at 1.7. I said 1.6. Excuse me. I meant to say 1.7.
Ever been abroad and needed Wi-Fi? Download Saley. Tired of telecom oligopolies ripping you off? Download Saley. Want to avoid sketchy SIM sellers at the airport? Download Saley. Saley might be the only travel app you need. It provides an internet connection wherever you travel and saves you money on roaming fees. It's easy to use, affordable, and reliable all over the world. Saley is the modern, seamless way to get connected without the need for physical SIM cards. With eSIM technology, you can instantly activate service from anywhere in the world. No more waiting in line for a local SIM or dealing with expensive roaming charges. Saley offers flexible plans to fit your needs, whether you're traveling for work or leisure. Plus, you can switch between networks in just a few taps, ensuring you always get the best coverage at the best rates. Whether you're a frequent traveler, an expat, or just someone who wants more flexibility with their phone, Saley's got you covered. No hidden fees, no contracts, just affordable, reliable data wherever you go. Visit saley.com/Loonie Hour for 15% off.
Well, I think one of the things, like Keith, it's like hanging over this, and I'm always looking at it through like the real estate lens, and I think what I'm seeing anyways is that the market was, the market was decent in the back half of 2024, early days of 2025. And I think just the whole tariff story, it's all over the media. Everyone's asking what the implications are. One week there's tariffs, next week there's not, then they're back on. Pretty hard to make investment decisions, not only on real estate, but as a business owner and operator. Do I hire more staff? Should I be investing in equipment and machinery? If you don't know, I mean, like these tariffs are so significant. And so I think just the freezing of activity, I think is going to be a huge slowdown on the overall
Yeah,
economy.
and to add to that, Steve, the tariff story is just not a Canadian story.
Yeah.
India is going to get absolutely whacked between the eyes with some coming up, as are a whole bunch of other emerging market countries. The Europeans and Brits, they're also vulnerable. And as you say, private capital, we don't like to lose money. So when we're deciding to allocate, tens of millions of dollars or hundreds of millions to build something somewhere, and there's a lot of uncertainty taking place, we will delay. We will delay
Yeah.
that. And that means there's less economic growth coming up. So if you're the Bank of Canada or the BOE or any of these other ones, I mean, I would imagine they could see that coming as well. And when they say, "Hey, we stand on guard, for thee from far and wide," all that stuff, they're going to cut rates. I think the Bank of Canada will still go down that road. So if people in Canada, they like rate cuts, you like your housing, we'll give you more rate cuts. I don't think it'll all get passed on, truthfully, but that is the direction they are going. And then, of course, the Americans could go in the opposite direction. Right. So remember, everyone, don't just view Canada on its own. You got to look at the whole world here. And you want to go to the American data
Yes.
next? I
Let's
thought it
let's
was
touch
really
on that because
important.
yeah, you mentioned the Bank of Canada. Obviously, a lot of the direction of where they are going to go is going to depend on what these tariffs look like. I think the markets right now, Rich, I think 60%, 65% odds of a BOC cut in March. But then you sort of shift gears over to the Fed and you say, well, okay, well, what's the Fed going to do? We just had the latest US CPI readings, which came in hot pretty much across the board. So, Rich, I don't know if you want to walk us through that.
Rich, they came in the opposite of your snow person you're building.
Really? Okay.
Oh God. Anyway, so headline is 3%. So remember, I think we joked about how 3 was the new 2 for America, and now I'm getting more and more confirmation that this is true. So headline inflation in the U.S. Ticked slightly higher to 3.00. Core is at 3.3 or 3.29. That's up. What's interesting for me, just two or three takeaways. One is, we talk a lot about rent of shelter or shelter component and how it's sort of screwing up the headline numbers and the core numbers. What was interesting is that services X rent of shelter in America fell to 3.94. So that trend is the same to a lesser degree as we're seeing in Canada, which is that shelter component is starting to sort of leave the overall number. Services is still really high, 4.22. What was interesting, and this is a warning for Canadians, is the goods component has now snapped back into positive territory and is 0.82. So that to me was one of the main takeaways. And that's partly because of the energy contribution to headline inflation, which we're seeing. And again, a warning to Canadians, I think we'll see the same. And the other thing that I thought was really cool was to me what the big red flag I think for the Fed is, and for people who are desperate for more rate cuts in America, is the 1 month change in the trend of the short term indicator, right? So, and now we've at 0.5, that's the biggest it's been in a year or more. And so what that means is July was 0.1, August through October was 0.2 month on month. Then November 0.3, December 0.4, and then January 0.5. So we're going in the opposite. So not only is it going up, it's accelerating. Anyways, my point is that to me is really, really interesting, which is starting to change the math. You could see on the day that data came out, the S&P 500 sort of collapsed. I mean, it didn't collapse, it sold off quite a bit. And then so that to me was really, really an interesting, it was a really interesting month for data. We didn't talk about the PPI, but I'll let you guys chime in. Oh, you're on mute there, Steve. Party foul.
Powell came out, right, and he said that there was more work to do after that reading, right?
Yeah.
So, Keith, it kind of makes you wonder, doesn't it? When, man, they were in a bit of a mad rush there to cut pretty aggressively before the election.
I know we had the race to zero theme going on.
Yeah.
Remember, we were pretty good with that until it kind of stopped, maybe. But
It's like all these conspiracy theories are starting to play out.
Yeah, the Fed is independent. No, they're not. You know, I think they're highly political all the time. But what's going to
Janet
be
Yellen
interesting?
did become the Treasury
Secretary, yeah.
Yeah,
and
she's
Mark
part of
Carney is
this-
going to be the next PM of Canada. There you go.
Boy.
Yay, yeah.
Yeah.
But let's stick with this conversation though about the central banks and where they're going. So Richard shared with us that, you know, employment growth in the US, it's okay. However, the inflation component is now sticky. It's not
definitely
coming down
sticky.
anymore. It's not coming down anymore. So if you are objective and you're looking at this, you're thinking they won't be cutting. You know, they have the opportunity to stop cutting, which it looks like they have right now. So then we look at the rest of the world. You know, we'll use Canada, you know, as the proxy here. You know, our growth data, it's not awesome, you know, on a lot of different points. The Bank of Canada are still talking kind of dovish. Then you jump over to Europe, and I know the UK. I think they had some positive GDP data. I think, but you know, everyone else they still haven't yet jumped to the sort of neutral hawkish stance that the Americans have. And until they do that, you know, you're going to have this divergence with overnight interest rates. And then that's a big deciding factor lots of time where money gets parked. So in the currency world. So the US dollar is looking, you know, a bit more attractive every time we see these data points. But Rich and Steve, you guys are sort of thinking as well that the Canadian CPI, maybe it too has sort of troughed. And maybe we inch higher.
Keith, well, Rich, I mean, you and
Keith and
might
I,
be-
Steve and I are going to fight this out. Go ahead, Steve.
Oh,
Well,
I
I mean-
remember. You guys already did this, and it was, I remember. Okay.
Well, I mean, like let's talk about through. I mean, clearly the Canadian dollar stinks, and so I can certainly see, especially with tariffs, that component. You know, the goods that you purchase at the grocery store, at Canadian Tire, those are, in my opinion, those are definitely, those are going to go up. But like, let's look domestically. I mean, the resale market, which is shelter, is what, 1/3?
Yeah.
One third of the
Roughly,
CPI basket. The rents are down double digits in many major metros. Resale prices, in my opinion, are under pressure. So that 1/3 of the basket, I don't think it's going up, but everything else might.
No, I mean, I don't know. I think the problem is Steve makes a really compelling argument. I'm just like sort of married to my model, which is exactly why I never make models in the first place, because people always get stuck. This is why you always have to be careful with financial models, because you know that you can always sort of get hung up on what that data point is saying and you lose the forest for the trees. So yes, services are going to come down. Services are a big chunk of it. In my view, it's the goods component. Those, you know, every major good, and we're going to talk about the US PPI, which is related to this, but, you know, crop products. So basically anything you pull out of the ground, animals and animal byproducts is up. Non-metallic minerals is up. Metal ores are up, even if you exclude gold. Logs and pulpwood, natural rubber, and forestry products. Those are basically every input that you have into the goods that we either procure or manufacture domestically is going up. And so I'm just saying, I wouldn't count my chickens.
Have you guys noticed, I'm just generally curious, have you guys noticed things that you buy or are looking to buy have gone up in Canada? Like
No,
recently?
I've noticed they've gone down.
So I'm the kind of the opposite. There's things that I'm like, and I think it's just a reflection of like these companies are having to adjust their prices due to the Canadian dollar.
Oh, interesting. Yeah, I guess
Right? I don't know. Like I'm looking at, for example, like, you know, you look at the new car market and like all these automakers are like having to raise their prices. And it's like, well, yeah, I mean, you know,
I was thinking about food at the grocery store because I'm seeing a lot more deals now than I ever saw, like, you know, 2 years ago.
Keith?
I'm not a good proxy for that because Mrs. Icecap does all of our shopping, so I'm not I'm not able to
He's
give
got
you
the
a
black
view on
credit
it.
card there.
So it seems like then, this whole inflation, discussion between you two guys, again, it's Steve's 1/3 of the basket against Rich's 1/3 of the basket,
Yeah.
maybe. And then,
Yeah.
and what
That's
about the
about right,
energy
actually.
component? You guys didn't bring in the energy, which is, I guess, indirectly associated with both. So I think though so what we're concluding here is that I think if inflation goes to the upside, that's going to surprise the market.
Mhm.
I think the market is still trending that inflation is now under control because those that be at the Bank of Canada, and the Squirmer and everyone else, they're telling us it's okay. It's you take a victory lap again.
I mean,
So we have to hope then. Oh God, that's eight
yeah.
times. That's eight times. We have to, if inflation does decline, it becomes softer, I should say. That's going to be a lot better for Canada. If it surprises to the upside, which is what Rich is suspecting, it's going to make some more uncomfortable moments here, coming up.
So let's summarize though. In summary, the US economic data is not weak. Inflation is accelerating, not decelerating. And so the Fed is, and I think it's pretty obvious that the Fed has now clearly shifted to the sidelines.
Mhm.
They're in a hold pattern. They probably ain't cutting anytime soon. The BOC is probably still getting at least another cut or two in, almost regardless. And it's going to come down to what these tariffs look like in terms of if the squirmer has to move even more. So, again, I think if you're looking at the outlook on the Canadian dollar, again, it's still hard to paint that bullish picture today. But again, I guess the question is, how much has the market priced in?
I think the currency is going to move to other factors in the near term besides this, but this will play out over the longer term.
And also, let's be clear that it's when you talk about the currency, you mean versus the dollar, right?
Yeah, Canadian
US
dollar
dollar.
against the US dollar.
Okay,
Yeah.
because the Canadian dollar just continues to move lockstep with, again, if you use a basket of the pound, sterling,
Yeah.
Japanese yen, and the euro, the Canadian dollar just continues to move lockstep with crude oil prices.
It's funny. I had a
It's
guy
amazing.
on Twitter the other day. I made a comment about that. I said Canadian dollar is actually not depreciating relative to everyone else. It's in line. It's a strong U.S. dollar story. Not a weak cat.
Yeah.
So
Oh my God, it was like talking to like a drunk grandmother. Like they couldn't get it, right? It didn't make sense to them.
It's a
But
fact. How can you argue a fact? I don't get it.
Well, I
Anyway,
think it
sorry.
comes down to though is, your view of the world. We always view the world from where we're sitting, and because we are so close to the Americans, we always view the Canadian dollar relative to the
Yeah.
US dollar. And if you're in a one great thing about actually there are a lot of great things about Europe, but one thing that's really noticeable when you chat with Europeans, that they are a lot of them are purely global, right? They're very global people. They do see the world differently. But not some people in Canada sometimes.
So a question for you though, like, if you're the Trump administration, your sort of goal and objective, especially with all these tariffs, is like, listen, we're going to bring back industrial production. I mean, a strong US dollar is not helping that, bringing that back.
Yeah, some of these things they don't quite reconcile. But I think though, like if they're able to onshore a lot of the manufacturing side of things again, the end market for what they're making and selling, it probably stays in the domestic market anyway. And again, like the cost to the world of tariffs, if everyone goes tariff crazy, global growth is going to slow and the cost of things will rise. You have that. I mean, the whole comparative advantage theme, we learn in economics and stuff, that doesn't matter anymore. That's gone. So again, this strategy, that's again, don't view it as it's right or wrong. You have to view it as it's happening it every single day. Like they're telling you, they print it for you. This is the direction we're going. So by default, we're going to have slower growth coming up in price. Back to Rich's now long-term view. my long-term view is for Rich's view on inflation. The cost of stuff should go up.
There's just two things I want to throw in there, which is one, the U.S., unlike many other countries, is one of the few countries in the world that really can kind of go at it alone. And I say kind of because obviously they don't manufacture heavy oil, as an example that people have belabored over and over again. But the way I come to that conclusion is their exports as a percent of GDP are far, far lower than, let's say, their European counterparts or Canada or China. So the U.S. exports as a percent of GDP are in the low teens. Canada, for example, is in the 30s. Europe, across the board, they're all in the 30s, in some cases 40s. And so just that's how and so there's that's one way of sort of assessing how dependent, and sorry, you imports and exports, divided by 2, you sort of get a gauge. And that's one way of seeing how dependent you are on foreign trade. The other thing I think it's really important, and we keep forgetting about, or we should remind ourselves, is this is not about, in my view, this is about China. And I think it's about what the US requires in this global conflict between the US and China. That's why steel is such an important fact. That's why semiconductors are so important. That's why rare earth metals are so important. Because I doubt that they're going to put massive tariffs on like mangoes from Chile or whatever, right? So I think it's really, I think it's more about that industrial security apparatus rather than just we need to bring back manufacturing full stop.
Yeah. So we'll see. We'll see what these how it shapes up. I mean, everyone's, we had a few comments on the last podcast. We've had Danielle Smith, we've had Sam Cooper back-to-back weeks. I mean, the commentary and feedback has been like overwhelmingly positive, and I think there's a lot of insight that was derived through those 2 interviews. We had the odd person that was like, oh, there's too much political conversation now, like this isn't for me. And we just want to emphasize that geopolitics is basically the name of the game today. I mean, that's influencing and impacting every single financial market, every major economy. And so as much as we try to steer clear of politics, because it's just kind of it's a lose-lose, it's just been so jarring that you can't not talk about it. So,
yeah. But I think, though, it's actually win-win, because if you figure it out, then you know what the policy is going to be coming up.
Yeah.
Do you see what I mean with it? And, so I think some people just need to grow up, Rich. That's all.
Well, Rich,
Rich
used to work at like a large hedge fund.
Yeah.
So like, I'm just asking as a general question. So just assume you're like a large hedge fund here. Would you typically bring in like a geopolitical sort of strategist, advisor in circumstances like this, where the world is moving so quickly and so, it just like, it feels like, years have happened in weeks. Like,
so yeah, the answer is 100%. As a global strategist, it wasn't a huge fund. It was a decently sized fund. As the global strategist for that fund, I would not have lasted more than a second if I did not have a view and know exactly what was going on for all the major conflicts, political sort of like fault lines, and anything, politics or not, that could move the market. And what does move the market mean have an impact on asset valuations and volatility across commodities, bonds, currencies, and stocks. And sometimes that would mean you'd have to be the expert on Japanese-Korean relations. And other times you'd have to be an expert on European politics, right? I worked for a hedge fund during the European crisis of 2013 to call it 16. I knew more about the Greek parliament than I ever thought possible. And if you did not understand how the voting worked, how it's a coalition government, then you did not understand Greek policy. You didn't understand Greek policymakers. You didn't understand the relationship with the EU and the ECB. You didn't understand how the bonds worked. And if you didn't understand the bonds, well, then you're fired, or they'll find somebody who can. And so even though I'm not a political strategist by any means, I had to know how the EU's political framework and apparatus worked to some degree, even if it was superficial at some time. It's a similar situation right now with Germany. If you do not understand what is going on with the AFD, how they're polling, what they stand for, what they want, what they don't want, who they're going to be their coalition partners, if they're going to have a coalition. If you don't understand that political part of the world, then you don't understand and you cannot make a reasonable judgment on the euro, on the ECB, on the DAX, on 100 other different things. And so this idea that we have to stay in our lane and only discuss real estate economics and finance or whatever, I think is frankly kind of almost a childish way of looking at markets. And by the way, similarly, next week, all that stuff might disappear and we won't think about it and need to think about it and know about it at all, right? We'll have it in the back of our mind as a risk, but that risk quotient and how it'll affect our portfolios and portfolio construction and the risks, et cetera, will completely dissipate. And something else will be important. And that's not to say that we just, slavishly follow the news cycle, but you must be aware and how. I don't know, Keith, if I misspoke, I think that's a fair sort of assessment.
Yeah, you're right. I mean, every serious investment manager in the world, that you have to consider geopolitics. Sometimes you put more weight on it, other times it's less weight on it. And this happens to be a time we need more weight. I mean, it is our belief the world is experiencing this transition from this like 40 plus 85-year cycle. And now we're moving to something different that is absolutely driven by the end of a lot of policies, which are, driven from the political side. So it's a great question, Steve. And, some people have views on things, of course, and some of these views are just completely wrong. So you have to really, I like to use the word, you want to be insensitive about these things. Rich made a really good point about the whole German situation coming up. And I know we keep bringing it up, and I think the election is
February 23rd.
Yeah, so maybe we'll cover this. Yeah, I think next week we'll try to cover a bit more detail on this probably. But these are things that could absolutely, for example, with Germany, it doesn't look like the election will go this way, but if it is a surprise with this AFD party, if somehow they do shock everyone, like the way the Brexit vote went in 2016 and the first Trump attempt to presidency in 2016, then it would literally lead to the breakup of the EU. So in 10 days, very dramatic statement, but the EU could look completely different than what it does right now. And it's not from industrial production or an inflation number, it's something different.
But the other way to think about it, Keith, is like, imagine you're working on a hedge fund desk or whatever, or pension fund, or imagine if you're a portfolio manager for families across Canada and the world. And the euro falls 10%. And your client asks you, oh, why did the euro fall 10%? Well, an anti-euro political party dominated the election of the most important euro area country. I didn't know because I wasn't paying attention. I mean, you could not imagine saying that to a client. I mean, you would be immediately be canned. One must be abreast of all these different issues, even like I said, even if it's just a superficial understanding.
Yeah, no, I mean, I think obviously that I share your guys' view. I mean, you are in that space and I'm not, but to me, like holistically, I think that makes sense. I mean, again, I think that's why we've tried to bring people like Danielle and Sam Cooper that are kind of in the political storm right now and are having a lot more sophisticated conversations than we are at the Loonie Hour. And we're just able to sort of parse that information off of them just through the network that we've built. But, that's why we looked at the Fentanyl Czar. We had Sam Cooper on, and everyone kind of laughs, thinks it's a joke. But I mean, if you talk to Sam and if you actually go and now listen to the interviews, so all of the premiers were out in Washington. Was it 2 days ago?
Yeah, and the prime minister. There was a tweet that says somebody we should lock the door and not let them out.
Oh, was he there? Okay. Anyways, they were all there, and it was funny because Doug Ford didn't want to say who they were talking to, but then like David Eby and here just like spilled the beans, and we talked to him and him and him and him. And they said, well, what did you gather from it? Well, and he was like, Well, they basically said that we should take Trump at his word, at face value, that what he says he means. And he wants us to take the border and the fentanyl problem very, very seriously. And this is not us saying, this is David Eby was in an interview saying, like, this is what we've been told. Take him at face value, and he's dead serious that he believes, right or wrong, that we have a fentanyl issue that needs to be resolved at the borders. We've now anointed a fentanyl czar, which we talked about with Sam Cooper last week. And it is a man named Kevin Brosseau. He's the former RCMP and recently served as Deputy National Security and Intelligence Advisor to Prime Minister Justin Trudeau. So in essence, it's another Trudeau appointee. I asked Sam about it. I said, Sam, what's your thoughts on this selection? And he's like, truthfully, I don't know much about Kevin. So I can't really comment. He's like, all I can say is obviously it's another Trudeau appointee. The White House is skeptical, concerned that liberal cabinet has been infiltrated. Hence why they haven't been sharing a lot of security information with them. So he's like, I don't know if this is going to appease, Trump and that administration. But he's like, it's too early for him to really comment on that. So we'll see.
Yeah, interesting. It's funny how people are still, the skepticism is just won't die. Like, so today the CBC came out with a huge article saying basically it's all bullshit. It's not, we don't have a drug problem. It's the other way around. They're sending us their drugs. It's like, oh yeah. I don't know. I don't know what they have to. At this point, I think it's ideological. I think, and that's to me disappointing, because their job is not to be ideological. Their job is to express the facts as they see them.
Yeah. Well, you know what? We should. I mean, like, we're going to wrap this up, but just to lastly, kind of wrap up the politics stuff. I think you can see this. Like, I think that Canadians are kind of rallying right now. There's a lot, I think a lot more unity. People are kind of treating this as like a economic warfare. I think that's showing up in the polls as well. We've seen a huge boost in the Liberal Party. Take it for what it is. Could be short lived, but I think people are just like, anything that looks anti Donald Trump is what we support and want. And so I think you're seeing that not only from the Liberal side through Mark Carney, but you're seeing obviously Pierre Poilievre is having to come out and sort of try to distance himself and talk about Canada first, because I think that it's going to be a huge battleground for these two political parties. Is to, how do you handle this crisis? And I think that this crisis has clearly been a boost in the polls for the Liberal Party. So we'll see. There's been talks. There was actually an article. I mean, it's been kind of rumored in our circle that we've been hearing, and then there was an article in the Globe and Mail as well today that it's believed that if Carney was to get in the Liberal Party, which to me looks like a shoo-in at this point, that they would actually probably call the snap election. And so the NDP apparently sent out a memo to all of their candidates there that they should be ready as soon as March 10th for a possible election. So we'll see. Lots of interesting stuff. Like I said, the politics stuff, as much as we try to steer away from it, it is.
I smell pretty nice opportunity coming up there, guys.
Save that for later.
An outstanding opportunity if something happens.
So I think that's it. Yeah, hopefully that was insightful as always, and we'll continue to bring on as many smart guests to steer the conversation and hopefully provide some insight to all our listeners. We appreciate the support. All we ask is that you share this episode with at least one friend, one family member, and we'll continue to build the Loonie Hour community. And we'll see you next week.